Okay, let's unpack this. We're doing a deep dive today into something called the microbalance revolution. It's focused specifically on advanced trading ideas for the Indian derivatives markets.
That's right. And our goal here really is to boil down some pretty complex ideas. We're talking institutional market profile theory,
Mm-hmm.
but making it practical. You know, how can traders potentially get more precise by understanding what the smart money is up to?
Right, because the whole idea, the promise, is that standard charts, they don't show the full picture. So this is about moving beyond just reacting to price wiggles and learning to spot institutional buying and selling patterns almost as they happen. Before we get into the revolution part, maybe we should talk about why the standard tools fall short. Like candlesticks, everyone uses them, but what's the problem?
Well, yeah, candlesticks are popular, definitely. But they really only tell you part of the story, don't they? You get the open, high, low, close for a time period. It's like seeing the outside shell of the activity.
But not what's happening inside.
Exactly. And that lack of internal information, that's what often leads to traders getting chopped up in those, boring sideways consolidations.
Yeah, sideways grind. Yeah.
Candlesticks just report that volatility dropped. They don't explain why. But that consolidation, that balance period, that's often the most critical time because that's where institutions might be carefully building up or getting out of big positions without tipping their hand too much.
Okay, so that's the gap. How does market profile try to fill it?
Right. So institutional market profile fundamentally changes how you look at the chart. Instead of just time moving left to right, it maps out where the volume traded vertically. You get a distribution shape.
Right.
And the core idea, the mission, is to help traders see when the market shifts from that state of balance where price is generally accepted into imbalance where price is decisively rejected and starts moving fast.
Balance is acceptance, imbalance is rejection and movement. Makes sense. Now, the sources emphasize this is tailored for Indian derivatives. Why that specific focus? Is there something unique there?
That's a good question. While the principles of market profile are universal, how you apply them can be market-specific. Indian indices like Nifty, Bank Nifty, they have, high intraday liquidity in their own structural patterns, often quite strong momentum phases.
Right.
So by using market profile here, the system is likely trying to pinpoint those typical pre-move balance zones, where tons of volume changes hands in a tight range on something like Bank Nifty futures right before a big directional pop.
So it's about filtering the noise specific to those markets.
Yeah, exactly. Tuning the analysis.
Okay, this is where it gets really interesting then. We've got this complex analysis, market profile. How do you make it easy? Or easier anyway.
Yeah.
The centerpiece seems to be these revolutionary color-coded zones. What's that about?
Yeah, the colored zones, they're essentially the user interface, the visualization built on top of all that profile data. They're designed to be like footprint markers, quick identifiers showing where the significant volume and positional commitment is actually happening.
The sources mention yellow, blue, and purple zones. So if we're thinking in market profile terms, what do these colors typically signify? Are they like value, area, point of control?
They usually map to key structural elements, yeah. For example, the yellow zone might represent the core value area, where maybe 70% of the volume happened. That shows where the market currently accepts price, where institutions are likely active.
Okay, the main consensus area.
Right. Then the blue zone, maybe that highlights a significant high-volume node, or HVN, perhaps forming just outside that main value area. Suggests another area of interest, maybe less committed positions.
And purple, that sounds specific.
The purple zone could be marking the absolute edges of that balance structure, like the high-volume node at the top or bottom, or the actual high-low of the balance.
Yeah.
The critical point where acceptance might flip to rejection. The goal is to show where smart money is positioning, but using these volume-defined structural points, not just time-based levels.
Got it. So instead of calculating value area low myself, I just see the yellow zone or the purple edge. It's like a shortcut to seeing the structure.
Yeah.
And trading with that smart money flow rather than guessing.
Precisely. You're trying to look past the simple price moves and see the underlying institutional activity that's actually driving things. It's a roadmap that simple price bars just don't provide.
Okay, so we can identify these zones. Now, how do we trade them? How do they create these high probability setups the sources talk about?
Well, the main strategy highlighted is trading the breakouts
Yeah.
from these balance areas.
Mm-hmm.
Remember, the colored zones define that balance area.
Right.
So a breakout is when the market rejects that established fair price, say the yellow zone, and pushes decisively beyond the edges, maybe the purple zone.
Okay.
The high probability aspect comes from the underlying theory.
Meh.
If the market strongly breaks out of balance, It's likely going to move quickly to find a new balance area. It's rejecting the old prices.
That makes sense conceptually. But trading needs discipline. The sources mention using very specific 1.1 risk-reward ratios. Now, that sounds... Most retail traders are chasing bigger RR multiples, right? Why lock in at 1.1?
Yeah, that's a really crucial point, and it does seem counterintuitive at first. But that commitment to 1.1 RR, it's not really about limiting your potential profit on any single trade. It's more about adopting a statistical high-frequency approach, often seen in institutional execution.
So.
Look, when you trade a clean breakout from a well-defined structure, like these zones provide, your entry point itself is high probability. But the immediate, most likely target is often just the next structural level, maybe the other side of the balance or a prior day's reference point. The R-year risk is very clearly defined, maybe by the width of the zone you just broke out of, or stopping back inside the zone. By aiming for a 1.1 reward based on that risk, you're targeting the most immediate, statistically likely move. This should, in theory, increase your win rate. You trade more frequently, aiming for consistency based on structure, not trying to predict a huge trend every time. It forces that institutional precision mindset, focus on high probability execution for the immediate move.
Okay. So it's about win rate and consistency over home runs. The precision comes from knowing your structural risk boundary and taking the immediate structural target. And that's how you turn those boring sideways consolidations into actual trade entry points.
Exactly. The consolidation becomes the setup.
Now, this whole framework, the zones, the breakouts, it feels like it relies on something deeper. The sources mention order flow quite a bit. How does that fit in?
Order flow is fundamental. It's like the engine driving the car, where market profile is the chassis showing the structure. If the profile shows you where the volume traded, order flow tries to show you how it traded. Specifically, the interaction between aggressive traders hitting market orders and passive traders providing liquidity with limit orders.
Right, the actual transaction.
Yes, the sources mention a resource, Order Flow Demystified, promising to show how real traders move the market, importantly, with no jargon, no fluff.
Yeah.
Conceptually, that means looking at things like delta, the net difference between buying and selling market orders at each price, or spotting absorption where huge market orders hit, but price doesn't move because passive orders soak it all up.
So if the market profile zones, yellow, blue, purple, give us the map, the structure, then order flow gives us the real-time confirmation. Like, is the breakout genuine? Is there actual aggressive buying pressure behind it? Or is it fading?
That's a great way to put it. Order flow provides insights into the conviction behind the move happening within the structure. You're seeing the why behind the accumulation or distribution patterns the profile highlights. Are buyers aggressive or are sellers absorbing them?
And the sources talk about 5 building blocks for decoding market moves using this. We don't need the exact list, but what kind of concepts would those cover typically?
Fundamentally, you'd expect those blocks to cover things like understanding the order book, or DOM, tracking delta and cumulative delta for pressure, identifying when aggression gets exhausted, spotting absorption at key levels, and crucially, linking all that real-time transaction data back to the bigger picture structure provided by the market profile. It's about building a layered understanding.
Okay. So what does this all mean? Let's try and wrap this up. We've gone through this micro-balance revolution concept. It seems designed to give Indian derivatives traders a clearer view, almost like an institutional perspective, by simplifying complex volume structures into these color-coded zones, yellow, blue, purple.
Right.
And then it advocates a specific trading style. High probability breakouts from these zones, but with disciplined 1.1 risk-reward targets aiming for consistency.
Yet the core shift, the big takeaway, is moving your focus.
Right.
You stop being just a passive observer reacting to a completed price bar, like a candlestick. Instead, you're trying to anticipate market intent. You're looking at the underlying structure, the volume footprint, the order flow dynamics to see what institutions might be doing now, which could drive future price.
It's a shift from reacting to history to anticipating intent based on structure and flow.
Exactly.
Okay, so here's a final thought to leave people with. If institutional buying and selling, this accumulation and distribution, can actually be quantified and color-coded like this, giving traders a structured glimpse into that smart money activity, What other hidden market dynamics might be out there waiting to be decoded if we just find the right way to visualize the market's structure and flow?
That's a fascinating question. It definitely suggests market moves aren't just random noise.
Right. Maybe they're just complex interactions that start to look predictable once you have the right lens, the right framework, like market profile or order flow, to see the underlying institutional game.